You know those moves in the market, the ones that just seem to take off in one direction and never look back? The kind of massive, one-sided price action that every trader dreams of catching? Ever wish you could spot them before they happen? Well, that is exactly what we are going to decode today.
Welcome to AI Explains ICT. In this video, we're diving straight into the concepts from Core Content Month 6, Episode 7. Our goal is to build a complete, actionable checklist that you can use to identify these exact setups. I'm serious, you're probably going to want to grab a notebook for this one, because these are steps you'll want to remember.
So our game plan here is a 4-stage process. We're starting from the top down, from the big picture, and zooming all the way in. First, we'll look at the whole market to see if the environment is even right for a big move. Second, we're going to play detective and follow the smart money to see what the big institutions are up to. Third, it's all about timing, pinpointing that perfect moment. And finally, we'll look at crowd psychology and how we can use that as our final confirmation.
All right, first things first. We have to start with the macro environment. You know, you wouldn't build a house on a shaky foundation, right? It's the same idea here. Before we can even begin to think about a specific trade, we have to ask the most important question. Is the market as a whole even setting the stage for a big, sustained move? This is our foundation.
For a market to really move explosively, we need the wind at our back. We need favorable conditions across the board. So, we start by analyzing the 4 major asset classes: stocks, commodities, interest rates, and currencies. What we're looking for is simple. We want to see trending environments, not markets that are just chopping around sideways. And here's the rule of thumb. For us to get a green light, at least 2 of these 4 classes have to be trending. And to be more specific, we need one from Group 1, that's either stocks or commodities, and one from Group 2, either currencies or interest rates. This tells us there's broad momentum out there that can support a major move.
Okay, so let's say we've confirmed the market is trending. That's a huge first step. But that immediately leads to the next critical question, right? Which way is it headed? How do we get confident about which direction that trend is likely to continue?
And this brings us to intermarket analysis. This is all about understanding how different markets talk to each other. Take a look at this. Here we've got the US dollar in green and a basket of commodities in black. You can see this classic inverse relationship. It's like a dance. When the dollar gets stronger and moves up, commodities tend to fall. And when the dollar weakens, commodities often rally. Understanding this dance between markets is absolutely crucial for confirming our directional bias.
So here's how we actually use those relationships to build a rock-solid case for our trade. Let's say our bias is bullish on the dollar. We think it's going up. To confirm that, we need to see that other related markets agree. We should see commodities hitting a ceiling, a resistance level, and just failing to push any higher. We should see foreign currencies like the euro or the British pound doing the same thing. On the flip side, if we're bearish on the dollar, we'd expect to see the exact opposite. Commodities and foreign currencies finding a strong floor, a support level, and easily breaking through previous highs. This is how we find confluence and get real confidence in our direction.
So the market environment is right, and we've confirmed our direction. But here's the million-dollar question. Are we trading alone? The next vital step is to figure out what the smart money is doing. We need to know if the large institutions are positioned on the same side of the market as we are.
To do that, we turn to the Commitment of Traders Report, or COT for short. Specifically, we focus on the commercials. Now, these aren't speculators. These are the huge producers and corporations that use the futures market to hedge their actual business operations. So by analyzing their net positions over the last 12 months, we can figure out if they've recently been accumulating buying positions or selling positions.
Now, at first glance, a standard COT chart can be really misleading. This red line here represents the commercials. You'll notice it's almost always below the 0 line. Conventional wisdom would just label that as bearish and move on, but that's a seriously flawed view. Commercials are often hedging by holding short positions, so this standard view doesn't really tell us what they're doing right now.
This is where the ICT approach offers a huge breakthrough. Instead of using that standard 0 line, we look at the highest and lowest points of the commercial's net position over the last 12 months. Then we draw a new 0 line right in the middle of that range. Now, look what happens. All of a sudden, we can see that even though they were technically net short by the old definition, they were actually in the upper half of their own operating range. They were aggressively buying relative to their recent behavior. This gives us a much truer picture of what's going on. The final piece of this smart money puzzle is open interest, and this is where we see a powerful confirmation. Check out the purple line. That's open interest. Notice how it takes a sharp dive from November into December. Now, at the exact same time, that red commercials line is rising. That means they are reducing their short positions. So think about that. A large drop in the total number of open contracts, while the biggest players in the game are covering their shorts, is a very, very strong bullish signal. They're telling us they expect prices to move significantly higher. So let's recap where we are. We have the right environment, we've confirmed our direction, and we know the smart money is on our side. Now, it all comes down to the most critical part, timing. How do we pinpoint that moment just before the market is ready to launch into orbit?
Well, one of the most powerful timing tools we have is seasonality. Markets often have predictable tendencies to rise or fall during specific times of the year. For instance, in this market here, there's a historically strong tendency for it to rally from December into the new year. So, aligning a bullish trade with a strong seasonal tailwind like this, it just dramatically increases your odds of catching that explosive move. Next, we look for a contraction in volatility. I want you to think of it like a coiled spring. A classic inside bar pattern, where the second candle's entire range is completely inside the first one, is a perfect signal of this contraction. It's the market getting quiet, building up energy, consolidating, right before a massive expansion in price. When this pattern shows up, after all our other conditions are met, it's a huge sign that an explosive move is right around the corner.
And that brings us to our final layer of analysis. We know the what, the which way, and the when. Now we need to look at the who. Specifically, what is the retail crowd, the general public, thinking and feeling? Because believe it or not, their sentiment can be the final piece of fuel for the fire.
This is a contrarian's absolute dream. Imagine you've done all your homework and you are strongly bullish on a market, let's say gold. Then, you open up the news and see headlines talking about prices dropping to 2-week lows. For most people, that's scary. That's a reason to doubt. But for us, that's actually a positive sign. This kind of negative news builds bearish sentiment among retail traders, making them hesitant to buy or even encouraging them to sell. This creates the perfect environment for smart money to accumulate their positions right before the real move up. And ICT sums it up perfectly. He says, if I'm bullish, bearish headlines are fuel in the fire. They're not a reason to doubt your analysis. They're the very thing that helps propel the explosive move.
Now, to get a more objective read on this sentiment, we can use an indicator like the Williams %R. It essentially measures where the current price is relative to its recent range, gauging momentum. But for our purposes, the concept is simple. When this indicator drops down into the lower green zone, the market is considered oversold. This is a strong signal that retail sentiment is likely very, very bearish, creating the ideal contrarian condition for us to be buyers.
So let's put it all together into your actionable 8-point pre-trade checklist. 1. Major market analysis. Are at least 2 asset classes trending? 2. Intermarket analysis. Do other markets confirm your bias? 3. The COT report. Are commercials buying or selling? 4. Open interest. Does it back up the smart money? 5. Seasonal tendency. Is history on your side? 6. Volatility filter. Is the market coiling up? 7. News headlines. Are they telling the opposite story? And 8. Market sentiment. Is the retail crowd leaning too far one way? When you can go down this list and confidently tick these boxes, you've found a high probability setup for a truly dynamic move.
If you found this breakdown helpful, please do us a favor and hit that like button and subscribe for more insights into the ICT methodology. If you have any questions at all, drop them in the comments below. A real human will get back to you. Until next time, safe trading. And I'll leave you with this to think about. Now that you have the checklist, the real question is, do you have the discipline to wait for all the pieces to align before you act?